Two of the most interesting thematics that we see playing out in Asia and that we've brought into the portfolio would be Asian gaming and online classified and advertising businesses. The online classified and advertising businesses account for about 12 to 13% of the portfolio today, and that includes three investments: Baidu, which is the equivalent of Google up in China, and two online recruitment websites, 51jobs and Zhaopin. What we see here in this thematic is online properties, so whether it be Baidu, 51jobs, Zhaopin, benefiting from the shift of advertising online as consumers migrate. We think there's a long-term opportunity here for these players to basically benefit from that migration. We think they've got very good online assets, and this is going to take place over the next decade. What we also see longer term is a great opportunities for these names to actually leverage their position in the market by pricing. This is going to be a story that plays out between year 5 and year 10, and it's similar to what we've seen here in the Australian market. The second thematic is gaming, and we've got two names there: Doneco International, which operates on the Vietnamese border. We believe this asset, which was basically a pretty new asset, only been around for 3 or 4 months, but we're playing the long-term growth in that asset as it builds out. And the other name is Genting Malaysia, which operates one of the older casinos in Asia, in Genting Highlands in Malaysia. What we see here is basically investors paying for the Malaysian asset, but getting the US and UK assets that the company owns basically for free. And there's also an optionality on the growth in the tables in Malaysia as they expand that facility over the next 12 to 18 months. Our view and our rationale behind our Aussie dollar position is based on bottom-up stock research that we're doing on the ground up in Asia. So what we're actually seeing from the work that we're doing on things like the Chinese banks, the Chinese commodity names, is basically telling us that over the longer term, we believe that the Aussie dollar is going to be, or the Australian economy is going to be hit by weakening fundamentals. And we think we're seeing that taking place now with a decline in iron ore sitting below $100, compared to $130, $140 12 months ago. So basically what we're seeing on the ground up in China is, what we believe needs to happen is a deleveraging of the Chinese bank balance sheet. And as that happens over time, we think that that's basically going to provide a downward pressure on the Chinese economy and also therefore on the Aussie dollar. Unfortunately, in the short term, the Aussie dollar's been held up frustratingly by government or central government intervention globally. If you actually look at rates here in Australia, we think 2.5% is actually quite low, but on a global comparison, that's actually quite high. 50% of the world's economies today basically have zero interest rates. So when you take that into account, the Aussie dollar and Aussie interest rates are actually quite attractive for global investors. We think that normalises over time, and then the fundamentals behind the Australian economy and what's happening up in China is actually going to start to impact on the Aussie dollar. We tend not to give broad views on markets, because what we really try and do at PM Capital is build portfolios from what we know about individual businesses and what we know about individual thematics within industries. So we're not out there taking a view on what we think is going to happen with the wider market. We're basically looking for 15 to 20 individual ideas or investment thematics that we can play over the longer period of time. And we think this is really important because if you actually look at our unlisted product, a lot of the investors that or the investments that we've made over the last 5 years have actually still been in the Chinese market, and we've made fairly good money on those positions, despite the fact that the Chinese market's actually been declining for the last 3.5 years. So it's really important, we think, for investors to focus on the underlying businesses. We've always said from the outset of this product that we're going to take a cautious approach and a patient approach to investing the capital. We don't want to just go to a fully invested position in positions that we think are going to act in line with the market. We're really looking for unique ideas that are going to outperform the market over a longer period of time. That being said, there's probably 4 or 5 names that are within 10 to 15% of where we'd be building initial positions, and we think if you get a bit of a pullback in the market, we're going to have the impetus and the opportunity to really add to the portfolio as it stands today.